Welcome back to the Deep Dive. If you are looking for, well, the definitive shortcut to understanding how rapid strategic transformation happens on a national scale, you are definitely in the right place. We are staff at WeWire, and this is your weekly Stay Wired recap. I'm John.
And I'm Wendy. We've taken a deep dive this week into the United Arab Emirates. It's quite an ecosystem. They've engineered one of the most successful, really coordinated transitions away from cash anywhere in the world.
Yeah, and the success isn't just theoretical, is it? The numbers really back it up. Let's start with this essential overview for you. Consumers have been really quick, to embrace digital options.
That's right.
Surveys are showing roughly 72% of UAE residents now prefer digital banking, mostly for convenience and, well, lower fees.
Sure, makes sense.
And in everyday payments, almost half of shoppers use mobile wallets. Think Apple Pay, Samsung Pay, or their local bank apps.
Right, the standard players.
And maybe the most telling figure. Contactless cards now account for about 84% of all card transactions.
84%. I mean, that's a figure most established Western economies haven't even reached yet.
Exactly.
And this isn't just random adoption. This is absolutely the result of a coordinated, high-level plan. Our mission today, really, is to show you why this matters. The UAE's strategy is a complete end-to-end blueprint. It's something for every emerging market looking to achieve rapid, stable, and systemic digital transformation to study.
Okay, let's unpack this then. Whenever you see a shift this dramatic, it must start right at the very top, right?
Absolutely.
This isn't just startups experimenting on their own. It's driven by high-level government policy. We're looking at sources citing the 2023 Central Bank's Financial Infrastructure Transformation Program, or FIT.
And the key word there really is infrastructure. It's deliberate, a design choice.
Okay.
The FIT program doesn't just, suggest people use digital payments. It explicitly targets a cashless society. How? By modernizing payments, introducing a unified set of open banking rules, and even trialing a digital dirham.
A CBDC.
A central bank digital currency, yes.
Wait a second. Isn't trialing a sovereign digital currency a massive undertaking? Politically, financially? Doesn't that potentially destabilize established commercial banks?
Yeah.
How do they manage that kind of pushback while going for such an ambitious goal?
Well, that's where the high-level policy connection is crucial. You see, the FIT program is nested within the much broader 2020 through digital economy strategy.
Ah, okay.
So the entire objective isn't just about making payments easier, it's a national economic strategy. The goal is doubling the digital sector's share of non-oil GDP from about 11.7% to over 20% within a decade.
Wow.
It means the entire nation is aligned. Digital payments infrastructure is seen as a driver of core economic growth, not just some banking amenity.
So institutional commitment is the bedrock here. They didn't just tell the private sector, okay, go figure it out. They actually built the framework and the plumbing first.
Precisely. They mandated a unified open finance regime. And this is crucial because it ensures all financial players, old and new, must adopt APIs and consent-based data sharing as standard practice.
Right, leveling the field.
Exactly. It levels the playing field for innovation. Furthermore, they created Al Etihad payments in 2023 specifically to run the national shared payment rails.
And this national infrastructure includes the new domestic card scheme, which they've named J1. For listeners maybe outside the region, what's a practical purpose of J1? Why build your own?
Think of J1 as like the UAE's own version of Visa or MasterCard, but domestically controlled.
Got it.
By establishing their own system, they streamline domestic transactions, they reduce reliance on foreign networks, and, importantly, they maintain a high degree of sovereign control over their financial data. It's a fundamental piece of digital infrastructure, not just, a branded card.
And they're building these rails while simultaneously looking forward globally.
Absolutely. We're already seeing regulations for stablecoins established, and they are actively running cross-border innovation pilots.
Like what?
Well, one source points to a blockchain-based payment corridor trial with China using the digital dirham. And this connects directly back to these big federal visions like We the UAE 2031, which emphasizes global integration and modern governance through technology. They're basically trying to export their financial model.
Okay, that brings us neatly to segment 2.
Yeah.
How did the market actually respond to this incredibly supportive, but also, I guess, prescriptive regulatory environment?
Yeah.
Where did the money flow?
Oh, the response has been explosive. I mean, when the government provides such clear direction and legally mandated stability, the private sector feels safe making big bets. The UAE is now firmly in the top 20 countries worldwide for fintech adoption, and get this, In 2022 alone, it attracted over $2.5 billion in fintech investment.
$2.5 billion.
That is transformative capital pouring in.
And a key part of drawing in that capital was setting up specific innovation zones, right?
Mm-hmm.
We're talking about places like ADGM in Abu Dhabi and the DIFC in Dubai.
Yes.
They didn't just open the door. It sounds like they rolled out the red carpet with these regulatory sandboxes.
The concept of a regulatory sandbox is absolutely vital for this type of rapid transformation. For those unfamiliar, a sandbox, often run under something like an innovation testing license or reg lab. Well, it allows new financial firms,
Like digital banks.
like digital banks or QR payment providers, exactly, to test their risky, complex new technologies under a relaxed set of regulations, but, and this is key, within a highly controlled environment.
So it's basically a safe playground monitored very closely by the regulator.
Precisely. And this strategy rapidly fostered dozens of firms. It allowed entirely new digital banks like Zand, Weo, and Liv to launch and scale really quickly.
So the regulator actively helps accelerate things.
Yes, rather than stifling novel consumer solutions. And when you protect innovation like that, the consumer shift can happen almost instantly.
Let's talk about that consumer shift. We
Oh.
mentioned the preference data earlier, but the speed of adoption really tells the story, doesn't it? It wasn't just gradual. It accelerated dramatically starting around 2020.
It's a classic case, really. Crisis acting as a powerful catalyst. The COVID-19 pandemic obviously pushed people away from physical cash contact.
Sure.
So non-cash payments jumped from 39% of transactions back in 2018 to a staggering 73% by 2023.
Huge jump.
What allowed that spike, though, unlike maybe in regions where infrastructure lagged, was the fact that the underlying hard payment rails were already in place.
And those rails are the core infrastructure developed through that FIT program we talked about, specifically the Immediate Payment Instruction Scheme, IPI, and the upgraded Aani network.
That's right. What makes IPI and Aani so game-changing is that they handle 2047 instant interbank transfers.
24/7.
Imagine sending money from Bank A to Bank B at 10 p.m. on a Saturday night, and the money clears immediately.
Right. No waiting till Monday morning.
Exactly. That speed and convenience fundamentally change how people transact, and it removes one of the last major obstacles to, well, ditching cash.
And we see the immediate impact of that speed in the economic data, don't we?
Yeah.
Particularly the e-commerce sector, which is just roaring.
Oh, it is the clearest marker of this transition. Online retail reached $10.8 billion this year, 2024, and it's projected to hit $17 billion next year.
17 billion.
But the crucial point is that over 71% of those sales are paid digitally, using those instant cards or digital wallets we mentioned. That shows a deep embedded trust in the digital ecosystem.
And looking at the larger commercial picture, the total merchant acquiring volume, that's sort of the macro indicator of commercial life moving online, right?
Mm-hmm.
That volume hit about $150 billion in 2024. That reflects a truly sustained compound annual growth rate, CAGR, of like 13 to 14% every year since 2020.
It's a fundamental rewire of the economy. It really is.
Yeah.
Which brings us neatly, I think, to segment 3. What is the so what here for other emerging markets? Because while the UAE isn't a low-income nation, its methodical success offers some powerful transferable lessons.
So what's the biggest lesson to export then? Is it the technology itself, or is it more about that government commitment we discussed?
It's the institutional synchronization. I think that's the core. Success demands building a complete end-to-end ecosystem. You need interoperable platforms, predictable regulation, and a proactive push toward inclusion.
Right.
You can't just launch a successful app without the sovereign rails beneath it. And if we look at the bigger picture of global wealth flows, just consider the impact on remittances.
Yeah, the UAE is a massive global hub for workers sending money back home.
Exactly. They have roughly $40 billion in expatriate remittances flowing out in 2023 alone.
40 billion.
And a whopping 57% of those outflows are already digital. That digital transformation fundamentally shifts how money moves between wealthy and developing nations, makes transfers cheaper, faster.
That is where the pattern really becomes clear, isn't it? We see similar success stories in other markets that prioritize unified national payment rails. Like look at Brazil.
Oh, definitely.
Their PIX real-time system is perhaps the most famous example globally, processing something like 42 billion transactions in 2023. That speed just completely redefined financial inclusion in Brazil.
Or you could consider Southeast Asia, which is obviously a diverse, fragmented economy. Even there, over 70% of e-commerce transactions were digital in 2023.
Wow.
supported by government systems like Singapore's Pay Now, and just the sheer power of adoption in places like Indonesia, where they have, 45 million active mobile wallet users?
Incredible numbers.
The UAE model really validates that high-level coordinated approach.
And the UAE isn't stopping, right? They're pushing even harder. Dubai has publicly set a goal of 90% cashless transactions by 2026.
90%.
And polls are suggesting the entire nation could reach full cashless status by 2030.
So the blueprint is pretty crystallized now. You need robust real-time rails, potentially incorporating things like digital ID and maybe a CBDC. You need active enablement of new entrants through regulatory sandboxes and mandatory data sharing. And finally, you need robust consumer education and trust. It's a whole cohesive national effort.
That whole case study is really a picture of strategic planned financial stability. It's fascinating. Let's maybe contrast that now with the turbulence we saw this week in the broader global markets.
Okay, yeah, let's zoom out for the stay-wired market context. Starting with commodities, which showed a really clear divergence, mostly driven by global risk sentiment.
Gold, the classic safe haven asset, extended its rally, recorded its 7th straight weekly gain, climbing roughly 2.5%. Why the strong performance there?
Well, it's a combination of factors, geopolitical uncertainty, for one, but also very specific concerns bubbling up regarding a potential U.S. government shutdown. That weighed heavily on sentiment.
Right.
Spot gold pushed above $3,859 per ounce. Investors are clearly seeking shelter from perceived instability.
Okay, meanwhile, oil was under distinct pressure. Brent crude sat around $64.79. The sentiment there felt bearish.
It was, yeah, largely weighed down by pretty straightforward oversupply concerns. Reports showed OPEC production rose by about 330,000 barrels per day in September.
Too much supply.
Too much supply hitting a nervous market.
Exactly. Okay, shifting to the FX corner. We saw some fascinating contrasts within African currencies, which always seem to reflect the underlying economic stories, don't they?
They really do. The Ghanaian cedi, for example, extended its losses. It depreciated by about 1.21% week to date. That reflects persistent domestic dollar demand and, frankly, dollar scarcity. It pushed its year-to-date decline deep into the red, now at negative 43.83%.
Ouch. Yet the Nigerian naira moved in the opposite direction entirely. It strengthened quite strongly by 1.26% week to date. What was behind that?
That rally was buoyed mostly by tighter FX liquidity management put in place by their central bank and also sustained inflows of oil-related dollars. It just shows the immediate impact of resource revenue stability when it comes through.
Interesting contrast. And globally, what was the big mover?
Globally, the biggest mover was probably the Japanese yen. It had its strongest weekly performance in months, surging 1.72% week to date. Again, riding that same wave of safe haven demand we mentioned impacting gold.
Right.
When global uncertainty rises, capital tends to flow into predictable jurisdictions.
Makes sense. And finally, just a quick glance at the week's most active stocks from the Stay Wired report. NVIDIA Corporation, NIO Inc., and American Airlines saw particularly high trading activity. Just remember, everyone, this information is strictly for market context and informational purposes only, not advice.
So to tie this entire deep dive together then, the UAE successfully demonstrates that a rapid, widespread digital revolution is achievable. But it has to be through a well-designed, nationally coordinated ecosystem. They've built trust and, crucially, predictability.
Yeah, and that engineered predictability stands in such sharp contrast to the weekly volatility and the resource-driven fluctuations we just discussed in the FX and commodity markets. It really shows that investing in foundational digital infrastructure isn't just about convenience. It's about creating long-term systemic stability.
Which raises, I think, an important question for you to consider as you wrap up your week, building on those global parallels we discussed. If successful sovereign-backed digital payment rails like Brazil's Pix or the UAE's IPI can rapidly digitize, say, $40 billion in expatriate remittances, what does that truly mean for the future influence of sovereign digital currencies on global wealth transfer and international monetary policy?
Think about the power shift it implies. A lot to chew on there. Thank you for joining us for this deep dive.
We'll catch you next time.
Stay Wired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the Stay Wired Weekly Recap.